do we need ratios?
Kind of gives like a breakdown of the financials.
Right, that's true.
And
So that's right. So basically, ratios are a way to summarize a lot of information about a company. So if you understand ratios well, and if you calculate 12 to 15 ratios, even before you read one line about a new company that you've never heard of, okay, a good picture of the company will start forming in your mind. So ratios, and especially if you have the ratio trends over 5 years, that will give you an even stronger view of the story of the stock. So you can, even before you read a line about the company, you can form a view about the company, and that view will be based on facts, right? So that's why ratios are powerful. So one of the first things that I do in analyzing any company, I'll actually go through that process. But what I do is calculate some of these important ratios just to see what kind of company is this. Is this a cyclical company? Is this a secular growth company? So what should my view be when entering? If you're entering a cyclical company, you would like to have a very clear target of when to sell out, yeah, and exit the market, because cyclical companies will go up, then they will come down. So there's no point of holding for a very long time. Whereas if it's a secular growth company, then you would want to get in at the right time when valuations are decent, and then keep holding them, right? So that's essentially what ratios does. So let's get going straight away. So these margins we have already discussed, so we'll not go in. So we'll directly go to something called ROCE. Yeah. So ROCE full form is return on capital employed. Yeah. So who can give me the formula for ROCE? So let's look at capital
it
employed. So
is
if you guys, yeah, Shantanu,
what
just a minute.
is it?
So
Sorry, huh?
yeah, so let's break it down. Okay, so return on capital employed. So let's look at capital employed. So last time we had discussed something about sources of capital and uses of capital, right? So can you tell me what can be the two components of capital employed? Like what kind of capital can a company employ?
Borrowings.
Correct. That is called debt capital. And the second one, if you can tell debt capital, automatically the second one will come to your mind.
The capital that they gain from IPO, shareholders, I
Correct,
mean
correct.
equity,
So that is called
equity
equity
generation.
capital.
Yeah.
Yeah, that's called equity capital. Exactly. So equity capital can come from IPO. It can come from your profits also, which are retained in the company, right? If a company is running after IPO, it's running for 10 years, then your equity capital, if it's a profitable company, the equity capital will keep going up, right? So that's absolutely correct. So there are two types of capital: debt and equity capital. So now that is the capital employed part. So how do you measure the return? कि तुमने इतना पैसा डाला कंपनी में, कंपनी ने एक साल ऑपरेशन किया, हाउ डू यू मेजर द रिटर्न कि उससे फायदा कितना हुआ? व्हाट इज द one metric? We have discussed this metric in the last discussion. Can you tell me what that metric is? So capital employed is the denominator in this ratio. What is the numerator of the ratio?
Is
Take
it
a guess. Yeah.
EBITDA?
EBITDA, good guess. It's not exactly EBITDA, but you're very close.
Or then is it EBIT?
Yes, exactly. It's EBIT. So, see what is EBIT, okay? It's profit before interest and taxes. Yeah. So, ROCE basically tells that you have employed some capital in the business in the form of equity and debt capital. Against that, what is your gain? What is your pre tax gain? Okay. So, that is why it has EBIT in it, because it's pre tax. If we were looking at post tax, we would have to look at a post tax measure, which we'll come to. There is another ratio for that. So, interest is not subtracted out from this, right? EBIT includes the interest. Uh, Whereas, we often like to subtract interest to and then subtract tax to come to profit after tax. So why do you guys think that interest is included in the numerator? Why does interest form a part of the returns that we are calculating? Who gets the interest? When a company incurs interest, who is the company paying the interest to?
To whoever they borrowed from.
Correct. So the people who have provided the debt capital, right? Whoever has lent them money, that's who the interest is going to. So that is the reason that when in your denominator you have both debt capital and equity capital, in your numerator you have both the returns to the people who have given you debt, which is the interest part, and the profit part, which is kept by the equity holders or the shareholders like you and me, right? So the profit of a company is what? After EBIT, you remove the interest, then you take out tax, and whatever is left goes to all the shareholders of the company. So that is one part of the return, and interest is another part of the return. That goes to the debt holder. So basically, ROCE is a ratio which tells you how much return debt holders and equity holders get for the amount of capital that they have jointly invested in the company. Does that make sense?
Yes.
Yeah, Bhavna,
Yes, yes,
Pranav, does that make sense?
yes.
Okay,
Yes.
cool. So, what is a good ROC figure? How can we judge what a good ROC figure is? Do you guys have any thoughts on this? Like you must hear or you must calculate different ROC figures, right? कभी किसी का 10%, कभी 15%, कभी 25%. So, how do you judge what is a good ROC figure? Any thoughts on this? Okay, so this we'll take up later. Yeah, just keep a note of this that we'll discuss on how to judge whether the ROC of a company is good or not later. So the next point. Next ratio is just a slight variation of ROCE. It is called ROIC, return on invested capital. Yeah. So you don't have to. One, I think Gaurav will make the recording available, and second, all these ratios just one Google search and you'll get them. So you may or may not choose to make notes. That's completely fine. You can focus on listening. So ROIC is basically return on invested capital, and the only difference is that in the numerator, the denominator remains the same. In the numerator, instead of EBIT, what you do is you subtract the taxes paid from EBIT. So basically, it is the post tax return to the debt holders and equity holders instead of pre tax return, which is measured in ROC. So it is called that numerator, which is EBIT into 1 minus tax rate, that is called NOPAT, NOPAT, which is net operating profit after tax. So I'm just giving this to you for information. There's no need to remember this. So ROCE and ROIC both are fine. Some people like to use ROIC, some people like to use ROCE. I generally use ROC. So ROIC is for people who want to check, okay, after tax, how much are they making? But like I told in the last session, tax can sometimes be up and down. So it can also be a little bit of a noisy ratio. So ROC, ROIC, both are trying to measure essentially the same thing, that after providing capital, how much return are the providers of capital getting? Yeah. Do you understand the difference between ROIC and ROC? Any question?
No.
Cool. So this one I want to hear from you guys. Just use the same kind of logic that we used for ROC and ROIC and try to tell me what will be the formula for return on equity. So this is only return on equity. This is not return on capital. So can you take a guess what might be the formula for return on equity?
Net profit by equity.
Absolutely. Net profit by equity. So this only calculates the return that is available to the shareholders of the company. So what is the return available to the shareholders? It's the PAT. After tax, whatever profit the company makes, that is what is available for shareholders. So it is simply PAT divided by the amount of equity the company has, right? So let's quickly go over to Screener and just check this ratio for some companies. Yeah. So which company do you guys want to see? One of the companies that you're looking at? Any company name?
Maybe put in rainbow or
Rainbow, yeah.
Krishna. Eh,
Cool. Let's do Krishna then because I am also familiar with Krishna. Let's go into Krishna, yeah. So let's see how ROE can be calculated for Krishna. So ROE for the entire year would be PAT, which you can see for March for the last full year. The PAT is 71 crores, right? And looking at the balance sheet, can anybody tell me for March 2022 what is the total value of equity in Krishna based on this sheet?
685 crores.
Yeah, it's 687, I think, because
Seven. Yeah,
six, yeah,
687. Yeah.
671
Sorry.
plus 16.
Yeah.
Absolutely right, Pranav. So let's pull up an Excel sheet quickly. And yeah, so for Krishna, let's consider PAT and let's consider equity and let's see what ROC is. So PAT is 71. Equity, how much did we say it was?
687.
687. Absolutely. 687. So the ROE is this divided by this. Okay. So it's about 10.3%. Yeah. There's another way of calculating equity, guys. So this equity is at the end of equity at FY22 end, right? This is the equity at the end of the year, right? There was also an equity which started at the FY22 start, which is FY21 end. There was a value for equity, right? Let's see how much that was. That was 249 minus 17, right? So this is 232. So 232. So another approach, average approach ROE, says that instead of the denominator being only the ending equity, what you do is the denominator you make it as the average of the starting and the ending equity, and then you calculate the ROE. Yeah. So in that case, this will be 71 divided by average of the ending and the starting equity. So this number improves to 15.5%. Now, it doesn't really matter which one you're using as long as you're being consistent in using one formula, right? So if you're comparing two companies, in both companies, you should use either the ROE, the simple ending equity method, or the average equity method, right? Average equity method is a little more fair because it's a fairer representation because like in this case you actually started the year with less amount of equity and you built up equity in the middle of the year because maybe you did an IPO or you did what is called a QIP where big institutional investors can come in and participate in an equity raise. So you earned more profit on a lesser base. So your ending base was high, but the starting base was low. So I think Screener uses this approach. So if you look at Screener, it uses the average equity approach. So last year ROE calculation is 15%. Okay. Now let's look at ROCE. Yeah. So for ROCE, we look at EBIT, and for ROIC, we look at NOPAT, right? So this is ROC, this is ROIC, and here we will look at EBIT. Yeah. So if you look at March 2022 EBIT, can you tell me what the EBIT was for March 2022 for Krishna? This column.
135.
No,
Yes.
135 is not correct. 135 is EBITDA.
Yeah, minus
Yeah, minus.
the tax.
No, EBITDA minus what equal to EBIT?
Sorry,
Your
depreciation.
the depreciation, right? Correct. So 135 minus
40,
41. Yeah,
94.
94 exactly. So So your EBIT will be 94. And your how much will your NOPAT be? So how do you calculate NOPAT? So NOPAT is basically you take out the tax from EBIT. Yeah. So it's basically just to write here, NOPAT is nothing but EBIT into 1 minus your tax rate.
हाँ.
Okay. So this will be 94 times 1 minus, say your the tax rate for India is 25%. So it will be approximately 71. So the tax for every year will be, different from 25%, because there is a concept called deferred tax asset and deferred tax liability, which means that every year the tax can deviate from the statutory rate, which is 25%. But if you calculate over a long enough duration, like 10 years, if you take the total PBT and PAT values over 10 years for a company, the average will come to 25%. So there's no need to go into that concept. It's a little complicated. So you can just use the statutory tax rate, which is the 25% tax rate for Indian corporate companies, right? So this is it. And okay, let's look at the equity capital. Equity capital, we already have it. So let's use the ending method where we are only looking at the ending capital, 687, and debt capital. Debt capital for Krishna was 41 at the end, right? Debt capital was 41. So the ROC, ROIC, ROC will be nothing but EBIT divided by sum of equity and debt capital, and ROIC will be NOPAT divided by sum of equity and debt capital. Right? So screener again uses the average method, so there'll be some difference. Let's go down and check. So according to them, the ROCE was 18%, higher than our calculated number, because their capital was lower in the average method. Yeah. And ROIC screener doesn't report it, but you can calculate it like this. Yeah. Is this clear, guys?
Yes.
Yeah.
Yes.
Yes.
So these are important return ratios. These tell you how well what a company is doing with the money that it is raising, right? What kind of return is it getting? So you should remember one thing, that over a long enough time, like a long term can be like 10 years. You can consider close to 10 years. Over a long enough time, the stock price sort of mimics the ROE, okay? Not the ROIC, the ROE. So if your ROE over 10 years is 15%, it is likely that your stock price will also grow at around 15%. That is provided when you took entry into the stock, the valuations were not very extreme. The valuations were somewhere comfortable. But in the short run, the ROE and the stock price percentage gain can change, can vary a lot. That's because in the short run, a lot of things determine, how the stock is doing. So one day there's a macroeconomic event, second day there's some problem in that sector, third, some new kind of fancy comes into the market, so all the money chases that. So there's a lot of noise in the short term, but in the long term, it is said that your returns will sort of track the ROE of the company that you're invested in. So the higher the ROE, the more sustainable your ROE, the better stock returns you can hope for if you're a long-term holder of the stock. If you're a short-term holder, then of course that need not necessarily hold true. Okay. Gaurav, anything to discuss?
No, no. I think that's
No.
sufficient. Yeah.
Okay, cool. So moving to solvency ratios, right? So debt equity ratio is an important ratio. What does solvency mean? Can any of you tell? You must have heard this word, right? Solvency, delinquency.
Is
Must have
it?
heard it.
I'm
Yeah.
not sure, but is it when the company plans to liquefy and all that?
Company plans to liquefy is
Liquidate, sorry.
delinquency.
Liquidate, huh?
Correct. When the company plans to liquidate, that is the opposite of solvency, which is called delinquency. When the company has basically run out of resources, right? So
Okay.
solvency is basically the opposite of that. So solvency ratios are balance sheet ratios which check the ability of the company to keep functioning as a going concern. So a going
Okay.
concern is a company which will continue to exist in the future. Yeah.
Yes.
So when I had said in the last session that balance sheet was important because it told you about the health of the company, so solvency ratios are a big part of assessing that health of the company. Yeah. So if there is more debt, a lot of debt on a company, and the equity base of the company is low, then you already have to be very careful of the company, because it might a situation might occur if the market doesn't support, if the company is not able to make profits, that its entire equity base might get wiped out, and it may not be able to make generate enough cash to even pay the interest payments for the debt that it has on its balance sheet. Yeah. So generally, a debt equity ratio of a zero point 0.5, which means for every 100 rupees of equity, a debt of 50 rupees is considered to be okay. I mean, if the debt equity ratio is below zero point 0.5, then it's considered to be okay, and the balance sheet is not under stress. There are other ratios also that you have to look at, but as a rule of thumb, you can use this. There are exceptions to this. For example, the banking industry works in a completely different fashion. So the banking industry has debt equity ratios of starting anywhere from 3 4, and it can go up to 14 15. So if you look at all these public sector banks or even SBI, etc., the debt equity ratios are extremely high. For HDFC, Kotak Bank also it's 3 4, right? So banking is a completely different kind of industry. So there, even if the debt equity ratio is high, you need not be worried, because banking industry works in a different fashion. We'll go into that in some other session where we discuss banking. Okay. So, and also companies like which make a lot of big investments, like infrastructure companies. Okay. Companies that are making bridges, or Shantanu, the sector that you are analyzing, railway companies where a lot of capex has to be done, those companies typically need a lot of debt, because the payments from governments come late. So to support their operations, they need a lot of debt. So usually debt equity ratios are high there, and it is not a cause for concern. But in any other company, for example, IT companies, you will see debt equity ratios are generally very low. FMCG companies, debt equity ratios are not very high. So wherever debt equity ratios are less than zero point 0.5, you can be comfortable. If it's more than zero point 0.5, you need to an alarm bell should go in your head, and you need to just do a few checks on the sustainability of the company. Okay. This is an important ratio, interest coverage ratio. Yeah. So interest coverage ratio is, I'll explain it through screener. So interest coverage ratio is nothing but in the numerator you have the EBITDA, and in the denominator you have interest. Some people, instead of using the EBITDA, also use the EBIT in the numerator, but you can also use the EBITDA. It's fine. So it is basically EBITDA divided by the interest payment you have made in the year. What is it trying to tell you? So it's basically the ratio is measuring that how many times of your annual interest commitment is your EBITDA. The higher this ratio, the safer the company is. Suppose a company generates 100 crores of EBITDA and its interest commitment every year is only 5, right? So the ratio is 100 divided by 5, 20, which means that the company generates enough EBITDA to pay 20 times the interest that it has to pay today. So which means that it can support a lot more debt. So tomorrow, if the company needs more debt to support its operations, it can easily take that debt, because whatever cash it generates or whatever earnings it generates, there's a lot of scope for it to pay that additional interest. But suppose a company generates 30 crore of EBITDA and it has to pay 20 crore of interest every year. So that means the EBITDA coverage ratio is 1.5. That is a very dangerous situation. And if the company goes to the market to for more debt, a lot of banks will refuse debt to the company, because they will say, see, already you are paying a lot of interest and your company is not generating a lot of EBITDA. So I won't lend to you, you're too risky. So what happens is the company has then it is not able to tap into debt easily. So it has to say that okay, you give me debt at much more higher rates of interest, which can cause even more stress on the balance sheet, right? So this EBITDA coverage ratio is pretty important. This is one ratio that I always check. You will find this ratio in the sheet of ratios that I had discussed in the last session. By the way, Shantanu, did you share that with the other three folks?
Yeah, the Excel sheet, right?
Okay, yeah.
Yeah, yeah.
Cool. So you can check in that sheet, there will be the EBITDA coverage ratio. So it's generally said that if your EBITDA coverage ratio is greater than 4x, then the company is fine. So if the ratio is 4 or more, then the company is fine in terms of supporting its debt. So this is just one other ratio to check whether the debt on the balance sheet is sustainable or not. Yeah. Okay. So next is debt service coverage ratio. I will not go into too much detail. This is just the same EBITDA in the numerator, and in the denominator, instead of just having the interest, it also has the current portion of the debt that you're repaying. So generally, when you take debt, when a company takes debt, in the following, say it takes debt for 5 years, in the following 5 years, uh, it is usually not the case that the company for 5 years will only pay the interest and then in the fifth year at the end of the loan will give back the principal. That is usually not how most of these loans work. What they will do is every year they will pay interest plus a part of the loan also. So debt service coverage ratio is just a slight modification of interest coverage ratio, where in the denominator, instead of only interest, they also add the portion of debt that you have to pay in the current year. Yeah, so this is just another ratio to check whether you're generating enough cash to service your debt. The last ratio is called financial leverage ratio. Yeah, so financial leverage ratio is nothing but financial leverage ratio is nothing but total assets divided by total equity. Okay, so if you come to Krishna, okay, for March 22, what is the total assets for Krishna? Come on, guys, this is easy.
877.
877.
Absolutely, 877. And the total equity we have already discussed is 687, right?
687.
Yeah, so it's 877 by 687. So it's 1.28. That's a very, very low uh, financial leverage ratio. I will show you other companies. Let's look at HG Infra. Here, the balance sheet size, the assets are 3280, and the reserves are about say 1436. So 3280 by 1436. So the financial leverage ratio is 2.28. Okay. Now I'll explain why we need the financial leverage ratio. It's because of something called Dupont. So you can see on the left that ROE can be broken down into a multiple of three different ratios. This formula is called the Dupont formula. Let's write it down. So ROE is nothing but PAT. So let the first line be the numerator, the second line be the denominator. Okay. So PAT divided by your equity, right? So this same thing can be broken down into these following three ratios, right? So first is PAT by sales, okay? Then sales by assets, and then assets by equity. So what happens is sales in the numerator cancels out, assets in the denominator, assets in the numerator cancels out, and you're left with the same ROE formula, PAT divided by equity. Is this clear, guys, that you can break down the ROE ratio into a product of these three ratios?
Yes.
Yes.
Yeah,
Yes,
Bhavna, did
yes.
you get this?
Yeah, yeah.
Okay. So, Bhavna, can you tell me what is the name of this ratio? PAT divided by sales. Profit after tax divided by sales.
I'm sorry, I don't remember.
Okay, no problem. So it's called the net profit ratio, right?
Okay.
It's called net profit percentage. Okay. So this one is net profit percentage. Sales divided by assets. This we'll cover in the ratio. We haven't actually come to it yet. So sales by assets is an efficiency ratio. So basically, just try to understand what this ratio is saying. Uh, it has assets in the denominator. Assets are what? Your factories, your machines, your buildings, your working capital, and you have sales in the numerator. So the more efficient a company is, the more sales it will be able to generate with equal number of assets. If there are two companies with equal assets, the company that is more efficient will be able to squeeze out more sales from the same amount of asset. So this is an efficiency ratio, sales by asset. It's called the asset turnover ratio. It's called asset turnover ratio. And Pranav, what is this ratio? Assets by equity, total assets by total equity.
Financial leverage.
Absolutely. FL ratio. We just discussed it, right? So ROE is nothing but the product of net profit, asset turnover, and financial leverage. Now, why is this formula important? This formula is important because if you have to understand why the ROE of a company is high or it is low, then breaking down the formula into these three will usually give you the answer. Okay. So let's take examples. So for Krishna, okay, the ROE was, we calculated the ROE, right? Uh, yeah, here. So for Krishna, it was 10.3%, right? Now let's see. This is a middling ROE. Okay, 10.3 is not a great ROE. Let's see where it is, having an issue. Let's see if it's net profit, asset turnover, or financial leverage. So let's go back to Krishna. Yeah, right. So net profit, how will you calculate? You will look at the profit and loss statement. You will take the net profit and you divide it by sales. So 71 by 455. So this is 15.6%. This is a very good ratio. 15.6% net profit is very good. Now let's look at asset turnover. Shantanu, I will just try to show you both the balance sheet and the. Okay, that is not possible. So can you tell me, Shantanu, how I will calculate the asset turnover ratio, sales by assets for Krishna? So what will be the numerator for this ratio?
Numerator would be sales,
Yeah,
and then
so
denominator will be total assets from the balance sheet, I guess.
correct. So 455 divided by total assets is 877.
877.
Yeah, 455 by 877. Now this is a very very poor ratio. Okay,
Oh,
asset turns are usually, I mean, an asset turn of 1 is considered to be pretty average. Asset turn close to 2 is better. Anything between 1 and 2 is good. Yeah. So here the asset turn is half. It's 0.5, which means, which can either mean, it can mean two things. Either the company, the nature of the company is very inefficient, that it requires tremendous amount of investment in factories and machines and everything to generate a small amount of sales, or it can mean that the company is in a phase of its life where it has installed a lot of equipment and a lot of factories, but it's just done it and the sales are yet to come. So the sales will come in the future. So this thing, this phenomenon is called operating leverage, where operating leverage is basically where you have made the investments, but you have not reaped the fruits of that investment. So you will hear this term a lot when you read con calls, when you go through analyst reports that, okay, this company has operating leverage, which will kick in. What does that mean? It means that the asset turnover ratio right now is very low, but as and when time passes, as and when the new facility, the new investments become a little older, the asset turnover ratio will increase, which will give a boost to your ROE. Yeah. And let's look at the financial leverage ratio. So financial leverage is nothing but 877 by 687. 877 by 687. Okay. So this is also like not too high. Usually this is higher than 2, but it's a very low debt company, so we can understand. Yeah. So this is the breakdown for Krishna. Now I'll take, yeah, Gaurav. Yeah, yeah. So see utilization. See, let's look at it, right? Asset turnover ratio is what? It's sales divided by assets, right? Now when your utilization ratio is low, that means your sales is low. So as the utilization goes up, your sales will increase and your asset turnover ratio will increase. So your ROE will get a kick. Correct. Correct. Yeah. Correct. Correct. Limit would be the limit. Yeah, that would be the best possible scenario. Usually, Gaurav, companies are not able to achieve 100%. They'll sometimes achieve 90%. Sometimes, in some industries, they will even exceed 100%. For example, yeah, the MDF industry, like if you follow Green Panel or Rushil Decor, they will say we have 105% utilization this time. So yeah, so the that is also another element of operating leverage. It is the same thing basically. If Krishna has put up new centers in Punjab, the utilization for them is maybe 5% or 10%. As and when it comes closer to the steady state utilization level of 70%, the asset turnover uh, gets a kick, and that causes your ROE to shoot up. Yeah. So now, guys, let's look at two companies in the same industry. This will give you a flavor of how to compare two companies, right? So, Shantanu, if you're looking at two companies in the okay, let's take an example of that is relevant to railways. Yeah, Shantanu, tell me two wagon manufacturing companies or three wagon manufacturing companies that you're interested in.
Titagar wagons,
Titagarh,
Jupiter wagons,
okay,
and
Texmaco, right?
Texmaco. Yeah.
Texmaco, right? So let's look at these three. And yeah, so let's start with Titagarh. Yeah, so the first is the PAT, right? So March 2022, okay, the PAT is negative. Okay, cool. That's why I usually don't like to take up these railway companies. Uh, okay, so it's been delivering PAT here. So what we'll do is, Shantanu, let us look at the
Quarterly.
quarterly numbers. Yeah.
Yeah.
And what we'll do is the half yearly profit is 6 plus 57, 63. We will just multiply it by 2 and consider that this is the normalized profit. Okay.
Sure.
So 63 into 2 is 126.
126.
Yeah, 126. And the revenue is about 1040. So 2080 will be the yearly revenue. So, yeah, so this will be 140, 126 divided by 20,
1040.
2040, right?
2040.
Yeah. So say 6.2%. Now let's look at asset turnover. So again, we'll use the same sales, say
Yeah.
2040. Sorry, this was 2080. It shouldn't matter, but let's try to be as accurate. So 2080 divided by the
Total as.
total assets, which is okay. Let us take the latest total
Yeah.
assets. Yeah. So it's
203.
2033. So 2080 by 2033. So this is not bad for a railway heavy engineering company. Let it be
Hmm.
that. And FL ratio is 2033 divided by say 883. Yeah.
883.
2033 divided by 883. So if you multiply these, you will get your ROE. Your ROE is 14.3%. Yeah.
Yeah.
Now let's look at Jupiter. For Jupiter, we do the same thing. So 37 plus 20 is 57, into 2 is 114. And here we have 300, 770, 712. So 1424, right?
Yeah.
So 57 into 2 by 1412 into 2. So so Jupiter Wagons is doing worse than Titagarh in terms of net profit.
Hmm.
Okay. Let's see how it's doing in asset turns. So
Sales
again,
again.
yeah, sales will be 712 into 2 divided by 1273, right?
Yeah.
12 into 2 by 1273. Here it is doing slightly better than Titagarh. Yeah. Now let's see financial leverage. So this is 1273 divided by. Okay, did we calculate this correctly for Titagarh? We'll have to recheck once. So 330, 680, 710, 721. So
21.
yeah, 1273 by 721, right? C. So it's 1.77. So the overall ROE is 8%. Yeah.
8%.
Uh, Shantanu, offline, just once check if the FL ratio for Titagarh we calculated correctly. Okay.
Yeah.
Meanwhile, I'll just do text Marco. So, Bhavna and Pranav, I hope you are following this, right?
Yes.
Yes.
Yeah. So, we'll do the same thing here. Oh, here, even this is negative. So, we'll analyze the September numbers. Yeah. So, 16 into 4 we will do. So, 64, and here we have 480 into 4. So, that will be 1920 approximately. 64 by 1920.
Yeah, by the
That's
way, yeah, I was correct, by the way.
it was correct. Okay,
Yeah.
cool. And asset turns here will be 1920 divided by 3038. Bad. 3038 divided by 1319. 3038 divided by 1319. Yeah, cool. So let's now compare. Okay, so if you had only done the ROE calculations, you would only have this much information, right?
Mhm.
But since we have broken it down, we can actually compare. So on net profit, Titagarh Wagons is doing the best.
Yeah.
On asset turnover, Titagarh Wagons and Jupiter are doing almost the same, and Texmaco is doing significantly worse. Yeah. Now, Shantanu, to establish whether Texmaco is actually doing significantly worse or whether it has new investments, you will probably need to read a couple of brokerage reports, or maybe analyze one or two con calls
Yeah.
to normalize this. That, is this a one-time phenomenon, or will this go ahead and normalize? Another way, Shantanu, is to uh, calculate this ratio for the previous years. So
Okay.
if you calculate the asset turnover ratio for the last 10 years and you find that the ratio is usually close to 1, but only this year it has dipped, you can safely assume that that is probably because of new investments, and the ratio will catch up.
Huh.
Yeah. And this ratio, see, the financial leverage is a ratio where you can always increase the financial leverage ratio by taking more and more debt, because asset is made up of equity and debt. So if a company keeps on increasing, keeps on pumping debt, then the assets will get inflated, equity will remain low, and the financial leverage ratio will artificially get inflated, right?
Yeah.
So whenever the ROE is high because of a very high financial leverage ratio, that's the poorest quality of ROE. That ROE is of the poorest quality. Whereas when ROE is high due to either of these two ratios being high, net profit or asset turnover, that means that the quality of ROE is really good and it's sustainable, because high debt may or may not be sustainable. for the company, right?
Yes.
So it's not 100% true in 100% cases, but generally, if the ROE is high due to the FL ratio, you need to be a little careful because the quality of the company is not automatically high in that case. Yeah, cool. So that's all about your ROE. And this DuPont formula is very, very common. And it is one of the most important formulae or equations that you will use. So do make a note of this. You can just Google it later on after the session. You will get the formula and explanations in detail. So don't worry if you haven't taken it down. Okay. Next, we have already discussed this to an extent, asset turnover ratio, which is sales by total assets. Then there is another, this ratio is mostly used for manufacturing companies, which have fixed assets, like which have a lot of factories, which have a lot of machines. So this is nothing but same. The numerator remains sales. So in the balance sheet, you will find something called fixed assets, right? So this comprises of all the machinery, factory, buildings, etc. So this will be the denominator. Instead of the entire asset being the denominator, this becomes the denominator. Yeah. So this tells you that for each unit of fixed asset, each unit of factory, land, buildings, and machines, how much sales am I able to get? So it's just another variation of the total asset turnover ratio. Yeah, sorry, I've mentioned it twice. Uh, yeah, then you have some important things, which is basically around working capital. So, guys, shall we continue? Shall we take up working capital today or complete working capital and valuation ratios another day? Because I want to make sure that you guys are not fatigued and you have my attention. So, Gaurav, you think we can continue a little bit, or we can maybe finish it up in one more day, maybe tomorrow or day after? Sure. Correct, correct. I agree. I agree. So, guys, is that okay if we stop here today and we continue maybe tomorrow, day after?
Yeah, it's
Yeah.
fine.
Yeah, because I think we'll be able to cover it in the next 15 minutes, but I would like you guys to think a little bit about these. So I think it's best to finish here. We'll understand working capital in more detail and the elements of working capital in more detail in the next section, and then we'll quickly go through these valuation ratios. These you're already familiar with, I'm sure, so won't take much time. Yeah. Yeah. Sure, sure. So I haven't really made anything, Gaurav. So I'll let me think up something. I'll post in the group. Yeah, yeah. Sure, sure, sure. I will do that. Anyway, there is one sort of not an assignment, but one task already given where that Excel sheet which I had floated, that Excel sheet has to be filled up for one company by each person, one of the companies that they are covering. And each person would take 10 minutes to go through that sheet and discuss the ratios of that company. So after we finish the next session, one of the days we'll anyway do that. Yeah. Okay. Cool then. So we'll catch up on one more day. Whatever is left of your Sunday, guys, enjoy and see you again.
Thank you.
Thank you so much,
Thank you
Thank
guys.
so
you.
much.
Thank you. Bye bye.
Bye.
Bye.